TSS and BTE have joined forces.
Context.
Power.
Edge.
The new paradigm of trading.
On Tuesday, May 12th, inflation came in blazing hot. You had the Middle East on the brink of this massive escalation, and oil was just surging, like right toward $100 a barrel.
Oh yeah, a total perfect storm.
Right. By all fundamental laws of economics, the stock market should have completely cratered. But instead, this single algorithm forced $9 billion of mechanical buying, and it just completely overrode the global economy.
It's honestly a phenomenal anomaly. I mean, we're also used to thinking that the news drives the market, right?
Right.
But what we saw during this specific week in May 2026, it proved that in the short term, the news is entirely secondary to these hidden mechanical forces that are just operating under the surface.
Yeah, exactly. So welcome to the deep dive. Today we are taking you right into the trading trenches. We really want to demystify this wildly contradictory week in the financial markets, so we're looking at Monday, May 11th through Friday, May 15th.
And the source material we have for this is just an absolute goldmine.
Oh, it really is. We're going through a full week's worth of daily founders and portfolio manager notes from SpotGamma. And for those who don't know, they're an analytics firm that basically maps out the hidden plumbing of the options market.
Right, and we are going to focus heavily on that concept of plumbing today, because our goal is to strip away all the geopolitical noise and that whole tech euphoria. We want to show you the actual gears, the levers, the mathematical formulas that literally dictate whether your portfolio crashes or soars on any given day.
Absolutely. So let's jump right into the overarching theme of the week. We're going to look at the macro reality versus the AI illusion. And Monday and Wednesday are basically the perfect proof of this.
Yeah, they really set the stage.
Because on paper, Monday morning looks like a recipe for a total catastrophic market meltdown. The notes detail how the president has just rejected a major Iran peace proposal. And just to be clear for you listening, we're impartially reporting on the events as laid out in the trading notes, not taking any political sides here.
Right, we're just looking at the market reaction. And the reaction to that rejection was immediate. Oil jumped 2% to nearly $98 a barrel.
Yeah, and you have that massive psychological threat of $100 oil just looming over everything.
Which is terrifying for markets. Because historically, a geopolitical shock that spikes oil like that, well, it's a massive left-tail risk. It's one of those low-probability, high-impact events.
Because higher oil just feeds directly into higher inflation, right?
Exactly. And higher inflation forces the Federal Reserve to keep interest rates elevated.
Yeah.
And elevated rates just absolutely crush the valuations of growth stocks. It's this whole domino effect.
Okay, let's unpack this for a second. Because on top of that oil spike, we also have the CPI, so the Consumer Price Index, and the PPI, the Producer Price Index, both coming in way hotter than expected.
Yeah, inflation was proving to be incredibly stubborn.
So the macroeconomic winds are just howling, everything looks terrible. But the S&P 500 and the NASDAQ are out there casually hitting record highs.
It's wild. But what's fascinating here is how the options data completely exposes this disconnect. In Monday's notes, SpotGamma pulls this data from Nomura looking at the QQQ.
And that's the ETF tracking the NASDAQ 100, for anyone unfamiliar.
Right, the NASDAQ 100.
Yeah.
So they analyze the 3-month skew data. And skew, basically, it measures the premium traders are willing to pay for crash protection, so puts, versus what they'll pay to bet on a rally, which are calls.
It's essentially the fear versus greed index, but priced in actual dollars.
Exactly.
So imagine the stock market isn't an economy, but it's a giant suspension bridge. And the fundamental news, like inflation, geopolitical wars, oil spikes, that's the wind hitting the bridge.
I like that.
But the options market, that represents the structural cabling. Usually those cables absorb the wind and keep things stable. But looking at this skew data from Monday, the wind is howling, and retail traders are out there actively cutting the safety cables to tie more balloons to the bridge.
That is the perfect way to visualize it. I mean, the Nomura data showed historic moves out of put options. Literally nobody was buying crash protection. Put skew was just tanking.
Wow.
Yeah, and meanwhile, call skew surged to the 100th percentile. Traders were aggressively crowding into one side of the boat, just betting so heavily on this upward momentum.
So I look at that and I think, okay, traders are betting that as long as these massive AI capital expenditure projections actually deliver, nothing else matters at all. Like, they are completely ignoring the macro headwinds.
Yeah, they had these two narratives that were priced for absolute perfection. First, the assumption that the Iran situation just wouldn't escalate into a real global supply chain crisis.
Right.
And second, that the AI boom would just continue to generate these astronomical corporate earnings, which would justify infinite valuations. As long as those two beliefs held firm, traders felt completely justified just ignoring the inflation data entirely.
But reality always tests perfection eventually. And that brings us to the actual mechanical tractor beam of the market. Let's use Tuesday as our sort of case study for how these mechanics operate.
Tuesday was incredible.
Because the HART CPI inflation data hits on Tuesday morning, and initially, gravity actually works. The semiconductor sector starts selling off pretty hard. But then, out of nowhere, the S&P 500 stages this massive V-shaped recovery, and it actually closes at 7,401.
And this is where we have to stop looking at the news and look directly at the plumbing. Because the reason for that Tuesday recovery had almost nothing to do with traders suddenly deciding inflation wasn't a big deal.
Wait, really? So the market isn't reacting to the fundamental inflation news at all? It's just algorithms playing ping pong?
Pretty much, yeah. It was driven entirely by dealer hedging. And the sources prove this using a really specific metric called HIRO.
Okay, let's break that down for everyone. HIRO stands for Hedging Implied Retail Options Flow. But practically speaking, what is it actually tracking on the screen?
Well, HIRO tracks the cumulative delta from customers buying and selling options in real time. So you can think of it as a live tracker for how aggressively retail and institutional customers are placing directional bets throughout the day.
Wait, before we get deeper into the flow, let's define these terms for the listener because, words like delta and gamma get thrown around a lot in financial media.
Yeah, good call.
If we stick to our physics analogies, delta is essentially the speed of the car, right? It measures how much an option's price changes for every $1 move in the underlying stock, so it's your directional exposure.
That's a great baseline, yes. And gamma, to follow your analogy, is the acceleration. It measures how fast your speed is actually changing.
Okay, got it. So back to Tuesday. What is the HIRO data showing us while the market is completely ignoring this hot inflation print?
So from the market open until about 1 p.m., the S&P was dropping, and the HIRO chart was relatively flat. There wasn't much going on. But after 1 p.m., HIRO just reversed violently.
Oh, violently.
It went from negative $2 billion to positive $7 billion into the close. Customers just started frantically buying call options, and they were heavily concentrated in 0 days to expiration or 0 DTE contracts.
So if you're listening to this and wondering why your portfolio suddenly bounced back on Tuesday despite that terrible CPI print, this next part is your answer. Because when you buy a call option, you are buying it from a market maker, a dealer.
Right.
And market makers do not take directional bets. They don't care if the market goes up or down. They just want to collect the tiny little spread on the transaction. But by selling you a call, they are mathematically short the market.
Exactly. And to neutralize that risk, to zero out their delta, they are legally and mathematically forced to go into the market and buy the underlying asset.
Which in this case would be S&P 500 futures or the individual stocks.
Yep. And because the ICE and HIRO flow spiked so aggressively with all these customers buying calls, dealers were suddenly forced to buy roughly $9 billion of delta notional just to hedge themselves.
I have to push back here, though. I mean, I get that forced dealer hedging creates buying pressure, but market makers aren't stupid. If the inflation data is incredibly hot and the macro picture is actively deteriorating, why wouldn't market makers just dramatically widen their bid-ask spreads to avoid getting caught short on those calls in the first place? Why let retail traders drive the bus off a cliff?
Well, it comes down to market structure and the sheer velocity of those 0 DTE options. You're right that in a normal environment, dealers widen spreads during volatile news events. But 0-day options have hyperinflated gamma.
Because they expire so quickly.
Right, they expire in hours, so their sensitivity to price movement is just off the charts. And the competitive nature of market making means algorithms are constantly quoting prices to capture volume. When an algorithmic wave of retail and institutional buying hits that fast, the dealers get filled before they can even meaningfully step back.
Wow, so they're trapped.
They are. Once they are short the options, their own internal risk management algorithms automatically fire off market orders to buy the underlying stock. It just becomes a reflexive loop.
$9 billion of forced mechanical buying. It genuinely doesn't matter what the Federal Reserve is doing at that point. That machine has to buy. And the SpotGamma notes specifically call out something called the seek and destroy algorithm, right?
They do, yeah. Because of this massive wave of forced dealer buying, the market price was basically dragged upward like it was caught in a tractor beam. The algorithm sought out liquidity, pushing the price right above the 99th percentile gamma strike, at 7,400.
And SpotGamma provides this brilliant visual for this in their notes using the trace gamma heat map. So for you listening, imagine looking at a thermal map of the stock market.
Right, so on this heat map, areas of positive gamma are colored purple. And you can think of purple zones as thick, sticky mud.
Right.
Yeah, because when the stock price enters a purple zone, dealer hedging acts as a stabilizing magnet. Because of how the math works, dealers actually end up buying when the price dips and selling when it rises. It suppresses volatility and pins the market in place.
Okay, so on Tuesday, that $9 billion of forced buying pushed the market right into a massive purple mud pit around 7,400.
Exactly.
That positive gamma completely absorbed the shock of the bad CPI data. The fundamentals screamed sell, but the options market's structural cables basically caught the bridge and stabilized it.
Which sets up a very, very dangerous psychological dynamic for the rest of the week.
Right.
Because when fundamental risks are repeatedly ignored like that, it breeds a sense of invincibility among traders.
Right, and here's where it gets really interesting. Driven by this mechanical support, Wednesday and Thursday push into peak euphoria. The elastic is being stretched to its absolute limit here, and the geopolitical backdrop for this is almost surreal.
It really is.
It's Wednesday, and the president is on an official trip to China. Again, keeping this strictly analytical here, but he hasn't just brought diplomats. He has brought the CEOs of NVIDIA, Tesla, and Apple with him to a major summit.
Yeah, you have the leaders of the most valuable tech companies on Earth sitting in China, and the market response is immediate and aggressive. The China Internet ETF ticker, KWAB, it jumps almost 5% in a single day.
The exuberance is literally everywhere. And SpotGamma tracks these extreme trades in a segment they call Flow Patrol. This really shows you the manic energy of the week.
Oh, the Flow Patrol stuff was wild.
Right. For example, they highlight a trader who bought Tesla one day to expiration calls. The stock rallied nearly 4%, and those specific options skyrocketed from 20 cents a contract to $14.90.
That is just the intoxicating power of short-dated leverage. But it's vital to note that the volatility went both ways. Another trader completely nailed a sudden pullback in the semiconductor space.
Oh, the SOXL trade.
Yeah, they bought puts on SOXL, which is a triple leveraged semiconductor ETF. And when the sector dipped 9%, those puts jumped 58% in a single trading session.
Just massive amounts of capital sloshing back and forth, hunting for these explosive overnight returns. But let's look at Thursday afternoon. This is the day before the big monthly options expiration, or OPEX. The S&P 500 breaches the 7,500 level, and the notes identify this as the massive call wall, basically the ultimate upside resistance level.
Right. And looking through the customer lens on the Trace dashboard, we see retail traders exhibiting a very specific, very aggressive behavior. They didn't just take their profits at the call wall and walk away.
No, they didn't. They rolled their bets higher. The data shows customers closed out roughly 39,000 contracts at the 7,525 strike, securing their gains. But then they immediately took that money further out on the risk curve, and they added 28,000 new contracts at the higher 7,550 strike.
And you might ask, why 7,550? Well, because options traders love psychological whole numbers, and that's where the next gamma concentration was forming. They are heavily addicted to the leverage. They're just assuming the dealer hedging machine will keep pushing the market up indefinitely.
But if I'm an institutional player, this so-called smart money, and I'm watching retail blindly push towards 7,500 while entirely ignoring global inflation, I'm definitely not buying more calls. I am quietly walking toward the exit.
Exactly.
And we actually saw that exact divergence in the Thursday flow data.
Yeah, if we connect this to the bigger picture, the smart money was clearly diverging from retail here. SpotGamma highlighted a massive trade in NVIDIA. An institutional player executed a 2-3-360 call spread that collected $13.8 million in premium.
Let's explain what a call spread actually signals here, though, because they aren't just selling their stock outright.
Right. A call spread involves bumming a call at one strike price and then selling another call at a higher strike price. By doing this, you are explicitly capping your upside potential to reduce your upfront cost, or in this case, to generate yield.
So they were playing it safe.
Yes. The institution was acknowledging that NVIDIA, which was already up 24% for the year and trading well above its key gamma strike, might be running out of immediate fuel. They were locking in their positioning before the music stopped.
And there was an even more aggressive bearish bet that same day in the memory sector. A trader dropped $1.3 million on put options against a newly launched memory ETF, ticker DRAM.
Yeah, that one stood out.
This ETS had only existed for a month and was already up 84%. Buying puts on it was a blaring alarm bell. The smart money believed the parabolic tech rally was exhausted and due for a violent snapback.
So you have this incredibly fragile market structure. Retail is rolling calls higher into the stratosphere, stretching the structural cables of our suspension bridge as tight as they can possibly go. Meanwhile, institutions are quietly buying parachutes.
Which brings us to the unwinding of all these positions. Segment 3, OPEX Friday. This is when the elastic finally snaps.
Options expiration day. So this is the third Friday of the month, the day when millions of options contracts all those massive gamma walls and stabilizing purple zones we talked about. They just expire and vanish from the market's plumbing.
You can only defy gravity for so long. Eventually, the mechanical support that has been propping up the market just disappears. So on Friday, May 15th, a sell-off in global bonds is the catalyst that finally cracks the armor.
It was a brutal day.
The S&P 500 posts its largest single-day decline since March, dropping 1.24% to close at 7,409. And the VIX, the fear gauge, spikes over 6% to 18.42.
But we really need to explore why the global bond sell-off was the specific trigger that broke the market. Because it wasn't just general panic. A sell-off in bonds means bond yields are rising, and higher yields immediately reprice the cost of capital across the entire economy.
So it breaks the whole perfection narrative we talked about on Monday.
Precisely. The assumption that AI companies could just borrow cheaply forever was shattered. And when that fundamental narrative cracked, it forced institutional algorithms to aggressively reevaluate their risk, which instantly bled into the options flow.
And this is where the plumbing violently works against the market. Because the exact same mechanism that saved the S&P on Tuesday is what dragged it down on Friday.
Right. The HIRO indicator went into reverse gear. As the market started to drop, retail and institutional panic set in. Instead of buying calls, customers started frantically buying puts for downside protection. And by the end of the day, HIRO had dropped to negative $6 billion.
So because customers are buying puts, market makers are on the other side of that trade. They are short puts, which means they hold positive delta. To hedge that risk, they are now mathematically forced to sell the underlying stock.
Exactly. They were forced to sell $6 billion of delta. So the dealers transitioned from being the buyers propping the market up to becoming net sellers, actively hammering the market lower.
And you could see this structural collapse happening in real time on the trace heat map.
Yeah, the purple zones just vanished. In the final 30 minutes of trading, the zone around 7,400 completely flipped. It went from being that sticky, stabilizing purple mud, and it turned bright red. And red zones represent negative gamma.
So that's the ice. There is no friction anymore.
Exactly. When the price enters a red zone, dealer hedging actually accelerates the market's direction. They have to sell when the market drops and buy when it rises. The positive gamma support evaporated because the options creating that support were expiring that very afternoon. The market basically slipped on the ice.
Which leads to the single craziest statistic from this entire deep dive. Because that mechanical support fluked so violently, it created a massive air pocket under the market. The 0-day to expiration 7,410 puts just exploded.
Oh, the move was staggering.
They went from 20 cents a contract to $2. That is a 900% gain, and it didn't happen over a week.
No, that 900% explosion happened in literally the final 10 minutes of the trading session.
It's insane. If you are listening to this and you've ever watched your portfolio suddenly puke into the close on a Friday afternoon for seemingly no reason, well, this is why. It isn't some shadowy conspiracy, and it isn't fundamental economic news hitting the tape. It's just the plumbing clearing itself out.
And this raises an important question regarding how we digest financial news in general.
Yeah.
Why should an average investor care about HIRO or gamma heat maps or OPEX calendars? Because understanding this plumbing prevents you from being manipulated by the headlines.
Exactly.
If you just watch the financial news networks, Tuesday makes absolutely no sense. Inflation is up, so the market should be down. If you trade on that assumption, you get crushed by the V-shaped recovery.
But if you understand why the market is ignoring the bad news, if you can see that $9 billion of forced dealer buying and that massive purple positive gamma zone, you recognize that it's a mechanical reaction. It's an algorithm balancing a spreadsheet. It's not an economic endorsement.
Yeah, and equally importantly, understanding the plumbing prevents you from being blindsided when reality eventually does set in. If you know that a rally is only being held up by expiring options contracts, you won't be shocked when OPEX Friday arrives, those contracts vanish, the structural cables are cut, and the market violently corrects. You learn to trade the mechanics, not the narratives.
So what does this all mean moving forward? The SpotGamma notes paint an incredibly precarious picture as we exit this week. Friday's OPEX stripped away all of those mechanical shock absorbers. The suspension bridge has literally no safety cables left.
None.
And looming right on the horizon, scheduled for the following Wednesday, is the undisputed heavyweight champion of the AI market, NVIDIA earnings.
And the options market is already pricing in a massive 6% implied move for NVIDIA on that earnings announcement. For a company of that size, a 6% swing represents hundreds of billions of dollars in market capitalization being created or destroyed in a single afternoon.
Which is just an astronomical amount of gravity to introduce to a market that just lost its shock absorbers. So I want to leave you with a final thought to mull over. We've spent this entire deep dive looking at how the options market reacts to and sometimes completely overrides the real economy.
Right.
But looking at the sheer volume of zero DTE options, the addiction to retail leverage, and these massive $9 billion dealer hedging flows, are we entering a fundamentally new era of finance? Are we reaching a point where algorithms and options market makers no longer just react to the fundamental reality of the businesses they are trading, but actually dictate that reality?
It is the ultimate market structure debate. Is the tail now permanently wagging the dog?
The fundamental warning lights are still flashing. The geopolitical winds are still howling. The only question now is whether the options plumbing will hold the bridge together or tear it down.